Okay, it's June 20th here on Thursday, and this is going to be a little different strategy session. First of all, the T2108 indicator, my thesis, my projection, whatever you want to call it, is we're going to bounce tomorrow, probably either at the open or within the first 5 or 10 minutes. I just don't see it going beyond that. However, in case I forget to mention it later, understand that there's a difference, and you have to understand this. I already know this, but maybe you don't. You have to understand that there's a difference between a short-term trade and not. In other words, just something longer than that. And here's my thesis. I think over the last couple days, yesterday, the market had a pretty nasty sell-off, and I was talking about that as being like day one. Today definitely was day two, no question about it. I think it was also a structural change, a breakage in the market. I think suddenly the bulls are saying, you know what, I'm not so horny. And the bears, not so timid. They're not teddy bears, now they're grizzly bears. Because some things have changed, and I've ranted about it enough in the forum, so if you really want to know what I feel about the Gang of Ben, go in the forum and read that. I won't bore you with either new thoughts or certainly with repetition, but in a nutshell, I think the market is looking at his comments in a few different ways. Number one, they're thinking, and nobody's really talking about this, but I can't see smart people who are kind of informed as far as how money works. I can't see them not thinking this way. At least I hope they're not missing this, that maybe the Fed actually hasn't really known what it's doing. It seemed real good at the time because they've got like a bazooka with an unlimited amount of dollar bills, so they can just keep firing, an almost unlimited amount of dollar bills, so they can keep firing it at the economy. But maybe all of this stuff really hasn't done anything more than what would have happened in the economy if they had not done anything at all and instead just let money go where it goes, and that is find a happy equilibrium between fixed income and equities, as opposed to trying to manipulate the market, manipulate, frankly, all the senior citizens who kind of should have been in fixed income but couldn't because they felt the market, they're not making any money, trying to manipulate everybody and pushing them into equities. And that is absolutely, undoubtedly what has happened. In fact, I'm pretty sure that Mr. Bernanke has kind of intimated that in one stupid speech or another about how asset prices, equity prices, blah, 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 blah. But make no mistake about it, the dislocation between fixed income, that is bond yields, and equity prices has been monumental. Not so much, and I hear some equity bears talk about how, valuations are stretched and we're not going to get really good earnings numbers in the third quarter and all that. And and that may very well be, but I'm looking at PE ratios and all that, and I'm not seeing stuff that's like really super extended. I'm not seeing these massive sky high PEs like we saw in late 1999 and early 2000. What I'm seeing, and I think what a lot of investors are seeing, is that relative to the yields on fixed income, equities, PEs are really, really stretched, which means one of two things. Either PEs are going to have to come down, meaning stocks are going to have to sell off a bit, or bond yields are going to have to come up. There's going to have to be some kind of a normalization so that the carry cost isn't so massive. In other words, like, what's the cost of actually having your money in something, in some instrument? Because there is a risk cost there, and there's also a cost of lost opportunity elsewhere. And so the bottom line is there's a huge carry cost in bonds simply because you're not getting anything in return for your money. And so there's going to have to be some normalization between bond yields and equities. And everybody who understands how money works, except apparently Ben Bernanke and the Fed, they understand that ultimately this dislocation is going to have to normalize. It's going to have to revert to the mean. Now, what these guys have been thinking is, and there's a difference between thinking and knowing. And by the way, that includes what I'm saying. I'm just the guy here with the microphone. I don't have all the answers. I just have a lot of really good questions in my mind. But what these guys were thinking is that by pushing all this money into the economy, by printing all this money, that ultimately the economy would recover. Now, it's never actually happened that way in the past, but maybe that's because the wrong people were in charge and these folks think they're the right people. I don't know. But that was really their approach. And so the problem that we're facing now, in my view, just in a macro view, on a real macro level, is, okay, the economy is not really picking up. There seriously is not an infinite amount of money. I mean, at some point, even the dimwits who with the printing presses are going to say, you know what, I kind of think I don't think we can really keep doing this. I mean, it's kind of, and I mentioned this in the forum today, it's kind of like an investor who's wrong on a stock, and he keeps averaging down and averaging down. But at some point, no matter how well-heeled that person is, if the stock that he is trading is ENE, which was Enron, at some point he's going to realize that he can't pile in enough money to get his money back. And so there truly is not an infinite amount of money. At some point it has to come to an end. And so what the market's concerned about is that the Fed, Mr. Bernanke, is starting to, they're making a kind of, you can see they're kind of hinting that they're going to end or taper. But tapering is not tightening. You can't really answer why. He's just saying it's not. That the Fed is going to kind of stop accelerating. They're maybe going to still be buying bonds, so it's all good, but we're not going to do it quite as much, But we're looking at the economic numbers, and we'll keep it going as long as the economy still looks like it needs help. But the risks going forward are not as big as they used to be. All of these things the Fed has basically said one way or another. And so what the market's interpreting is that, they may curtail their bond buying before the economy really recovers. Or let's put it another way, they may realize that perhaps their bond buying is no longer even helping the economy. So why keep doing it if it's not working? That's kind of like the definition of insanity. And so the market, in a nutshell, is doing this. The market is anticipating kind of a reversion to the mean in the difference or the dislocation between equity returns, between PEs, between rising equity prices and rates and yields. That's really what's happening. We can throw out all the blame, and you know where I throw it. I think the Fed is a bunch of hubristic knuckleheads who have more degrees than a thermometer, but less common sense than a squirrel looking for nuts. There, I said it. But forget about all that. That's just me ranting. And if I offended some of you, you know what? I'm sure you're going to live with it just like I do. But in a nutshell, away from all of that stuff, what the financial markets are really dealing with is, you know what? I think we need to be selling bonds here because they're just not working at these low rates. And I think that there's going to be a reversion to the mean. And so it's kind of a self-fulfilling prophecy. And I think it was Doug Cass that was saying this on Fast Money, to where he was really saying that if people are anticipating rising rates, or if they're anticipating lower equity prices, or the combination of the two, then as the market continues to do what it's doing, that's going to become a self-fulfilling prophecy, and it's going to kind of become a feedback loop. So anyway, hopefully I'm clearing up some of this. All, again, you really need to know is that there's a massive dislocation between the returns that you get on bonds, which is like nothing, and the return that you get in equity prices. Well, here's the thing. Nothing goes up forever, not even hot air balloons. Nothing goes up forever, and the market knows this. Traders know this, and the only reason equity prices will continue to go up is if buyers are aggressive. For every stock, there's a buyer and a seller. So buyers are not more numerous than sellers on the uptrends. Sellers are not more numerous than buyers on the downtrends. There's an equal amount of supply and demand on every single stock, on every single bond, in every single market. It's the relative aggressiveness that dictates price direction. And please, I'm giving you pearls here. You may not agree with my viewpoints on various things, and that's fine. And I really don't care, because there are alternative views, and I could be totally wrong. But I'm not wrong about the way stocks and bonds trade. And you need to understand this, that it's an aggression thing that dictates the price movements. And so what we're seeing now is, and I had CNBC on kind of on and off during the day, but I heard somebody say what I think really sums up money managers like hedge funds, big guys, and frankly even small investors, that there are those that participated, they were long and strong, they're happy, they got all this money. Well, those are the guys that are selling now, a lot of them. By the way, you should be one of them. You should have been one of them if you were really profitable. Why ride it all the way down? But so those guys, the ones that are riding some really nice profits, are protecting them by cashing out. At the same time, there's a lot of fund managers who have not been participating in the rally. They've started to chase, and I've been talking about that lately. I mean, that was kind of part of my rationale for higher equity prices, is that there's money on the sidelines, money's coming in, money managers are chasing performance, they're going to have to get in. But here's the deal, at some point, and have never been making fundamental arguments. It's all about crowd psychology and just simply return on investment. So those folks that, quote, missed it, okay, they're seeing the sell-off for the last couple days, and they're saying, you know what, I'm finally right. I mean, I knew this was going to happen. Some of them, by the way, have recently capitulated and bought. Well, they're selling now because they don't want to buy at the top. So you've got the potential demand, the folks the money that wants to be put to work, that hasn't been put to work because it felt like the market was overdone to the upside. Or, as a friend of mine just said today, the market has been greedy. They don't want to buy just yet. They're standing back because they're saying, I've been right and I missed this upside. Well, I'm darn sure not going to buy after just a stupid 5% correction or something like that. So the potential demand for equities on the way up is not there now. It's backing away. And so I want to get on to, I have a lot of things to say, and this video is probably going to run over, but the good thing is you can listen to it in double speed here. But what I'm really trying to help you out, because here's the thing. I talked with Gary, and he said he's heard from several members through emails, and I've seen some posts in the forum, and the real kind of the consensus among those who are vocal is, you know what, I kind of screwed up some things and I just need to get back to basics. I just, I mean, and nobody, and this includes me in my trading, you have nobody to blame but yourself, unless somebody hacked your account and started buying and selling stuff. And it's actually nice to see people saying like, darn it, I goofed up. I have to get back to basics. Okay, so let's get back to basics. And that's what I'm talking about here. For you traders, there's going to be some buys tomorrow, and I'll go through that stuff in a little bit. But for you longer term guys, don't do anything tomorrow. Don't do a darn thing except go golfing. Okay, and if you don't golf, well, good for you. The ball's too small and the clubs are too small and they never go straight, so I don't like it either. But do something other than try to get your money back. Don't do that. So we want to get back to basics here. But we have to understand that the market moves up, the market moves down, and it all is dictated by the relative degrees of aggressiveness between buyers and sellers. Now, I'm going to go through some stocks because I don't want you to get bored, but I want you to stick through this video because I've got some basics for you. I've got some things that I want to talk about, and I swear at the end of this video, you're going to think, this is kind of what I needed to be doing. Okay, so we're going to get into that, but let's go through some stuff here. Okay, so we're looking at the T2108 indicator. This is the percentage of stocks above their 40-day moving average. We got only 21% above the 40-day moving average. The green line is the S&P. Look what happened the last time we got this low. Big move up in the S&P. Look what happened the time before that we got this low. Big move up in the S&P. Keep in mind, though, we got a lot of gyrations here. This one, sorry to be kind of moving this around so much. This one, we came down lower than we are now. We got just a little fake out in the S&P, and then it went lower. So this is not the perfect indicator. Here, screaming buy. When you got like less than about 5% that are below their above their 40-day moving average, it's kind of time to buy. So here we've got the rubber band that's totally stretched tight. If we look here, this is the 4-week new high versus new low ratio. This is also at a really low level. This is a pretty good short-term indication at very extreme levels. Here we got to buy. Watch the line up here. Here we got a buy point. Back here, we got a buy point. Here, buy. Here, buy. Even here, like for a day, a buy. So, like I said, I think if you're a trader, buy the open tomorrow morning. I think you're going to do fine. By the way, keep a stop. If you're buying the SPY, here's your trade. Buy the trade at the open. Keep a 2% stop on the S&P. Do you really think the S&P is going to drop another 2% from where you bought? Answer, no way on God's green earth. It's not going to happen. So if you just want to make a trade that you're going to be profitable on, buy the SPY. Doesn't look like you want to buy it, does it? Buy the SPY at the open tomorrow, set a 2% stop, and the most you're going to lose on that trade is 2%. Okay, and you know what? I can live with a 2% trade. Not every day, but on most days, I'm good with that. Buy that and then sell it when it goes up a little bit. Okay, there's your trade for those of you that are looking to trade. But I want you to look at this too, and we're talking about short-term stuff about bouncing tomorrow. Okay, the tick index. This measures like how many stocks we're trading on the bid versus how many stocks we're trading on the offer, how many listed stocks. The lower the number, the more stocks we're trading on the bid. In other words, how many stocks were being sold. Well, you can see where the low is. Typically, right here, this is where it really kind of closed, which would be like how many stocks actually closed down versus closed up. But if you look here on the intraday stuff, it was almost 1,400 down at the maximum. I got to move it up here. Okay, that's a pretty low That's a pretty low number. We saw some lows like that, I think even yesterday or something like that. So we've seen, these lows. But my point is, on a lot of different levels, the market is super, super oversold. And this is a market that you sure don't feel like buying, but you kind of have to, because typically the ugliest potential trade is usually the best one. That's the most profitable. So that's what I'm going to say about short-term traders. But again, you need to differentiate between if you're a short-term trader or have a longer-term mindset. I think there's a big difference between the two. When the S&P, and it's gonna bounce unless there's something that's really nasty that comes up, when the S&P bounces, you're likely to see some selling here, perhaps even there. But I'd be really surprised if we don't get a bounce. But, I'll just go out on a very, in my view, very strong limb. This is what I'm expecting. I don't know exactly where these levels are going to be, but I expect a bounce to some extent. But I'm looking at the market as really kind of being broken here. So this is the good news. And seriously, there is some good news. If you're a longer-term investor, you don't have to do anything right now. You've got a long-term view. What's the difference between buying on Friday, triple witching, ugly day Thursday, little reversal on Friday? What's the difference between buying on Friday versus buying next week, the week after that? I promise you, the prices that you get in a week or two, worst case scenario, if you're looking to buy, are not going to be that much higher than they are now. Oh, they will probably have been higher, but they'll also have been lower. You're going to see here that there are going to be some really good buying opportunities on some stocks, but they're not going to be tomorrow. So if today kind of rattled you, and I think it did, judging by, the correspondence that we've had and seen some of the posts in the forum, I think it rattled a lot of people. Well, here's the thing. Welcome to trading. When Drudge reports and some of the kind of, non-market related websites start posting headlines about the Dow or the S&P or whatever, you're kind of supposed to be shaken up. Okay, that's why it's news. Like they say, if it bleeds, it leads. So if you're sitting here and you're discouraged, look, don't be. Happily, these days don't come very often. And I promise you, if you stick with it, in a week or two or three or a month or two or three, you're going to look back on this and you're not really going to remember just how intensely discouraged you were. You just won't. So what you need to do is really focus on learning from this. Okay, let me get through this stuff. First of all, let's look at levels here. There are a number of different levels. I saw Carter Worth on Fast Money. I forget which level he was looking at. I think he was saying like the S&P could pull back to 1450, okay? Because I don't know if it was because it was some level here, some Fibonacci retracement or whatever, but frankly, you know what? That's just an arbitrary level. And I love Carter's work, but he doesn't really know. He's projecting. Here are some projections you can take to the bank. One, this is the November low versus the recent high in May when Bernanke decided to speak. 61.8 is a retracement right here at about 1556, give or take a few. Okay, that could work. Okay, this could work here from this last high, about 15, what was it? The high was 1597, 1600 or so. Okay, well, we've blown through this. So then we've got this retracement here, this 61.8, which is really 38.2% retracement. So we're coming back to 61.8. Or we could come back to 50%, which would be what, about 1515. But if it comes down really, really fast over the next couple days, that will also coincide with the 200-day moving average. Or we can come back to this 38.2 level here. So there are a lot of different levels that the market could come back to. And nobody really knows for absolute certain except the liars, and that's not me, which is why I'm telling you I don't know. I just think that we've got lower prices to come. Again, I'll have to say it because, somebody's, going to forget. I believe that tomorrow we're going to get some kind of bounce, but it's a trading bounce. Don't get sucked in if you're a long-term investor. Don't do it, okay? Now, let's look at the other stuff. Dow, okay, this is busted. I mean, there's no way around it. It's broken. We'll probably, if we get a move up to 15,000, I about guarantee you that that's going to be sold into. It's almost a lead pipe cinch. Okay, let's look at some stocks. These are some Dow stocks that are nice uptrending stocks. Here's your levels to watch. Okay, if Chevron pays 3.3% yield, which is not bad, I think that's probably more than the 10-year note. If it gets back down to the 200-day moving average, that's a pretty good buy point. Okay, so buy some. JP Morgan, okay, watch about 51 bucks, certainly 50 bucks. If JP Morgan comes down to 50 bucks, buy it. Doubt it's going to do it tomorrow. Okay, American Express. American Express has been pretty steep, okay? It's been really steep, kind of tough to sustain this. Watch 71. That's about where the 50-day moving average is, but here's the deal. Okay, after 71, watch, 68. That's down around this level, this prior high here. And then after that, you can watch about 62, which is where the 200-day moving average is. One thing you want to do, and write this down and think about it, when you're considering stocks that look like they're correcting, look and see where the 200-day moving average is relative to the price, relative to the high, okay? This was really far extended. Now, how do we know it was far extended? Well, when do we see that extended to this level, like right here? Okay, fine. Well, look what happened to American Express. It started rolling over and moving sideways. So I don't think you're really going to miss a buying opportunity if you stand aside and don't buy American Express right now. Now, look at Pfizer. This is what you're seeing in a lot of stocks. These, a lower low, and you say, well, maybe this is that shot across the bow, that first sign when, oh my gosh, something's amiss. Okay, well, look at this massive volume here on the rally, only to do what? To fail at the prior high. Do you want to buy Pfizer right now? I don't. I love the uptrend. But if it comes back, and by the way, 3.3% yield, if it comes back to 27, then, and all of these I'm talking about if you're a longer term trader, not, like an investor, not a short term trader. You don't want to be buying Pfizer when it falls back to 27 so you can sell it at 27.80 for a nice quick little day trade. Don't mess around with this. But if you're a longer term investor, Pfizer's going to work. You just don't want to be buying it right here. Look at McDonald's. McDonald's. Okay, breakdown. Here was the pattern. Okay, this is the breakdown right here. And then this was, somewhere around in here was the congestion level. So what happens to the stock? The stock moves up. Okay, now we don't know when it moves up here whether it's going to break through. I would think that it's going to roll over, which it ultimately did. And why would I think that? You guys know how I look at this, because in here, after the stock breaks down, everybody's a loser. Nobody likes being a loser. A lot of folks are going to do something about it. If they can get close to getting their money back, they're going to go ahead and sell so their wife or their husband likes them again, because nobody wants to lose money, particularly if it's the family's money. So here, what are we going to do? Well, I'm not looking to buy McDonald's yet. If it falls down, by the way, this is over 3% as well. If it falls down further, maybe so. But am I looking at this as a right here, right now moment? I don't think so. Okay, let's look at the transports. Okay, this isn't really working either. You could say, oh, well, it's down here at this buy point. Okay, fine, but look at all the tops and bottoms on this chart. Is this really a big whoop here? We've got a lower high. Okay, so you don't have to rush in on this thing either. You just don't. Now, NASDAQ. Okay, this is kind of busted. If it gets down to about 2,800, or let's look at the composite. This is kind of busted. I tend to focus on the NASDAQ 100, but this is kind of busted. If it falls down to about here, you know, look for a buy. But it got too extended here. Okay, now I want to talk about some basics because it's important that you think about these, and I can tell since I'm hitting 30 minutes now, this will be of record length. But I really think that you've got to know this stuff. So start taking notes if you haven't already, please, because what I'm going to talk about are basics. Okay, number one, write it down. I'll wait. Okay, 1 dot space. When in doubt, get out. Okay, it's your money. If you're uncertain, there's a reason why you're uncertain. Okay, it's okay to get out. It's okay. The market's going to, as long as tomorrow's a weekday and not a holiday, the market's going to be open tomorrow. So if you're in doubt, if you're feeling uncomfortable, get out. And by the way, the definition of discomfort and quote getting out may be just cutting down your position size. But don't sit there and hold an uncomfortable position. Trading is hard. It is. But it doesn't have to be agony. It shouldn't be agony, and it shouldn't be self-flagellation. You should actually feel, and you will if you really focus on this, and I hope you're writing this down. Okay, if you're learning, you're going to start feeling really good about trading. And by the way, here's your first rule. Start journaling. And I guarantee you, and yes, I'm talking to you, you are not journaling. You're not writing down your trades. You're intending to. You know you're supposed to. I'm not the first one that's told you this. Write down your trades. Write when you entered. Write when you exited. Write why you entered. What was your thought process? And by the way, what was your plan? You did have a plan, right? You had a plan. Like, why were you buying? Because you saw, you know, that I happened to mention a stock and said something favorable about it. Okay, well, that doesn't work because, number one, I covered typically about 20 stocks in every video. Also, I can be wrong. I am wrong. No question about it. I get a lot of stuff wrong. So if you happen to get in on that trade, is that really why you got in? Because I was bullish on it? Make your own decisions. Have your reason. Write it down. If you make a profit on a trade, write down what was good about it. What did you do right? And also, what did you do wrong? You are writing this down, aren't you? Okay, in your journal on the losing trades, and this is really important, identify one, possibly even 2 or 3, but at least one mistake you made. Write it down. Keep it on a separate list. Stupid mistakes that I made. Okay, not make, made. Write it down. What you are going to find, I promise you, you are going to find that you make the same mistake again and again and again. And then after that, after the weekend, you make it again. Do you know why? Because you're not writing it down. You're not journaling. You're letting it ride through your stop. You don't have a stop. You're trading too big. Your position was too big. Then the stock fell over, and you were like at max pain. You sold it all, and then the stock ran up. Okay, whatever. You are going to make the same mistake again and again and again. And here's the thing. This is reliable. You're going to make that mistake for as long as you trade, until you start writing it down and you realize that that's the mistake you're making. Then you're not going to do that anymore. And think about it this way, okay? If you're holding the board with a nail in it, okay, and you got your left hand on the board, and the nail is just a little bit to the right of your thumb, and you're hammering it, and you take the hammer and you swing it down and you hit your thumb. And then you swing it and you hit your thumb again. By the way, it really hurts, okay? So you're going to do that again and again and again until finally you say, you know what, maybe I need to kind of like just move the hammer over a little bit to the right because my thumb's getting sore. Okay? But if you don't realize what your problem is, how are you going to do that? Your thumb's just going to hurt a lot. So write it down. Thank you. Okay. Also, number 2, this is number 2. When you're uncertain, trade small. That's it. Trade small. By the way, if you have kind of a normal position and you're uncertain, this goes back to the first one. When in doubt, get out. Lighten up. I do this all the time. I do it all the time. Rarely do I just look at something and go, oh my gosh, I'm so right, I'm going to pack it on, and I just pile in. Typically, if I'm feeling uncertain, I'll chop down my position, particularly when it comes to options. Though a lot of times if I feel like I'm kind of uncertain on options, I just close the position out, because the magic of leverage is I can make it all back in a real fast amount of time once I'm right. But the magic of leverage too is I can lose a whole bunch of money really, really fast if I'm wrong. Okay, a few more. Write this down. No revenge trading. No revenge trading. And that I'm talking about a couple things. First of all, if you lost money, okay, you're not trading well. Maybe I should say if you lost a lot of money, you're going to make losing trades. It's going to happen. It's okay. That's trading. That's why they call it trading, not money harvesting, okay? You're going to make losing trades. But if you're taking an inordinate amount of losing trades, or if you've lost, more money than you're really comfortable losing, what you're going to tend to do is trade more aggressively to make it back. Okay, well, if it was that easy to make money, like, oh, I just have to trade harder so I could make that money back. Well, if that was the solution, then why don't we just do that all the time? Because that's what we want to do, is make money. No. When you're losing money, when you've made some bad decisions, well, for crying out loud, you're not having a good day. Sit on the bench. Get off the field. It's okay. Okay. The market doesn't care about you. The market doesn't know that you've lost money in the last trade or two. The market doesn't know that you're down 20% on a stock and you're embarrassed to say that. The market doesn't know about you. And if it did know about you, it wouldn't like you, because the market doesn't like anybody. It's rigged to take the most money away from the most amount of people at the most inconvenient time. Once you understand that and you are journaling, you're going to be among the few, among the elite, that when the market rolls big time, you're going to get hurt a little bit, but you're not going to get taken out of the game. When the market starts behaving as it, quote, should, and sometimes it does, you're going to be making more money than the other guy. You're going to be doing fine. But it all comes down to understanding the market doesn't know about you, and it darn sure doesn't like you. Okay? Now, a couple more. Long term. If you're a longer-term trader, be diversified. Don't have more than 5% of your portfolio in one stock. No more than 5%. That's it. Okay, and that doesn't mean you have to own 20 stocks. You need to have a cash component. Or how about this? Have 50% of your portfolio in the S&P. How much did you lose today? If you had 50% of your portfolio in the S&P, okay, you lost 2.5%. Your portfolio dropped 1.25% just because of the history-making decline in the S&P. I should say headlines. So the S&P made headlines because you were 50% invested. You lost 1.25% on your portfolio. That's not that big a deal, okay? But if you had 100% of your portfolio in Pulte Home, you're down almost 10%. So the point is, be diversified. You're not going to do as great as you would if you were in the top stock, but you're not going to do as badly as you would if you were in the worst stock either. So I want you to have no more than 5% of your portfolio. I'm talking longer term traders or investors. Have no more than 5% in one stock. And here's the other secret. In building that 5%, do it over time, not all at once. Okay? Don't just go, 5%, boom. Take whatever your normal position size would be on 5%, take 25% of that, take 30%, maybe take 50% of that, and only add to a winner. Okay, so by the time you get a full position size, you're profitable. You're in a better position right there. Okay, also watch moving averages and slopes. In other words, how steep is the stock trending? For example, is it topping? If it's not just going up, is it topping or is it consolidating where it's probably going to move up? Okay, you want to look at how much it's already moved. Okay, for Ambarella, yeah, okay, the low back here was $6. Now it's at about 17 or so. So is this a top? It could be, but it hasn't been trading that long. So, you know, I'm looking at this and, you know, fine. Look at what Google, not that this is Google, look at how Google moved before it really kind of formed any kind of a top. So I'm looking at this. This is consolidation. Okay, Intel, doubtful that this is a top. I mean, yeah, it was down below 20. Now it's up at 25 here. This is just probably consolidation, and you could buy some around here. Okay, Lululemon. Okay, I'm looking at this, and maybe this is a good buy point now. But if you look at the weekly chart, you know, this kind of could be a top. I mean, for crying out loud, it was down to under $3 here, and now it's up at 62, went up to 80. You know, that's a heck of a return. So maybe this is a top. Reason I'm going into the difference is because if you're a longer term investor, you kind of missed the move on Lululemon. Hate to tell you, but you missed it. Buying at 62.70 doesn't entitle you to the kind of profits that somebody made who bought it at $6.27. So this is a top. You don't want to be if you're a long-term investor, you don't want to be buying this right now, because if you're a long-term investor, by definition, you'll have plenty of time to make money on this stock. Buy it. If you really believe in this stuff, buy it when it really takes a dump. And I don't think today, down 3%, I don't think a move from when Christine Day, announced that she was stepping down and the stock company announced some kind of crappy numbers. I don't think the stock's done going down to a point where it's going to start moving higher and get away without you. It's due for a rally. We'll probably move a little bit. If you're a short-term trader, take it. That's fine. Okay, Home Depot. This might be a top. I mean, look how much the stock's come down. So if you're a long-term investor, you're looking at this, and do you want to buy this stock right now? I wouldn't, not as a long-term investor, not really as a trader either, because I'm seeing all of this resistance here. The stock's broken below the 50-day moving average. It can trend higher for a little bit and then probably come into more selling pressure. So if I'm a long-term investor, do I really think that I got to rush and buy the stock right here at $74 because I'm never going to get an opportunity to get it lower than that? How can you say that? Okay, we can't do that. Got it, and it all starts with determine your time frame. Determine your time frame. Okay. Now look at Cree. Okay, I'm looking at this. My gosh. So Cree back here, stock was down at in the teens, ran up to $80. So you'll look and say, well, this sure was kind of a violent top, but chances were pretty good that this was toppy. Here, we don't really know that so much. If you're a longer term investor, then I still don't think this is your best opportunity. I think you wait for it to be closer to the 50-day moving average. And then here's the other thing. It's important for you not to be buying at a top. So don't buy a stock. If you're buying a stock that's hitting all-time highs, that's fine. Just don't buy a bunch of it. And then when the stock moves even higher, you're profitable, then you add a little bit more, okay? But you don't just go pile in. So with Cree, it looks like a pretty nice uptrend. You want to buy on the dips. But understand how far the stock has come. So if it starts falling below the 50-day moving average, well, then you need to take a hint because it hasn't really done that before. So these are the types of things that are going to help keep you in the game. They're going to put you in a position to win. I promise you that. They're going to put you in a position to win. And the way you get in a position to win is you avoid being in a position to lose. And I'm not talking about having an unprofitable trade. I'm talking about losing like life-changing, bad stuff blowing out, losing a sizable chunk of your portfolio. And I did that once, several years ago, during the, like 2 or 3 crashes ago, whatever it was. I lost a gob of money. Took me a few years. I forget the exact number, but it took me, we're talking years, in order to get back to where I was before. And I'm a good trader, and I really had to work. But by the way, if you lose a boatload of money, are you really a good trader, or did you just kind of have a nice streak, or maybe the market was working in your favor? Okay, so don't get too full of yourself. And so I describe myself as I'm a good trader. Let's just say I know a lot of stuff, but all it takes is one mistake, a big mistake, and all of a sudden the good trader isn't so good, which is why there's that saying, you're only as good as your last trade. So I was an awesome trader up until that trade, then not so good. So by the way, if this has happened to you, then get back on your horse. Just kind of get a Shetland pony, okay? Don't get on the big Clydesdale. Get on a little Shetland pony. Get back in the game slowly but surely. But don't let the market get to you. And remember some of the basics that I'm talking to you about. Okay, we're going to keep going here. Consumer staples. Okay, this is busted. Okay, this is not supposed to happen when the market gets a little uncertain. Okay, Kimberly-Clark. It's really not supposed to be doing that. PepsiCo, not really supposed to do that. Procter & Gamble, I could go on and on. Pick a stock, I'll do it. Procter & Gamble, not supposed to be doing it. So this stuff is not supposed to be happening. So look at this. Don't just rush in to buy tomorrow. This means something. Now, what about the XME? Okay, you traders, this is probably going to bounce tomorrow. Probably going to get a nice bounce there. Am I calling a bottom? No, not on this stupid thing. But I'm looking at this and I'm seeing this test of prior support. Here's your trade. Go ahead and buy this puppy right where it is. Right where it is. Okay, 34.20. Where's your stop? Just a little bit below today's intraday low. 33.76, a little below that. And by the way, if this gaps down, go ahead and buy it. Then your stop is about 2% below where you bought it from. You're probably going to make money on that trade. Okay. Now, Alcoa. This is the stuff that everybody hates and nobody wants. Look at Alcoa. This is probably going to be a pretty good trade tomorrow too, for a trade, not an investment. Okay. Alcoa, pretty nasty downtrend. Prolonged base here, but am I calling a bottom? No, but I'm saying this. If you buy the stock and then it starts trading below 797, then you took your shot. Get out. No big deal. Okay, home builders. They're probably going to get a little bounce tomorrow. They really got shellacked here. Look at Pulte Home. Okay, right off the 200-day moving average. This is probably going to get a little bounce, but it's kind of a broken stock, at least. I mean, if I'm a long-term investor, I'm not getting into this right now. But if I'm a short-term trader, I'll get into it. And then if it runs up to, say, 21 bucks or so, I'll sell that and say thank you very much. Okay, Home Depot. This could be broken. It's a fall below the 50-day moving average. If it moves back up, say, to this level, I think you're probably going to get some selling. Why? Well, because all these folks who bought, like right here, are losing money. And also, all the shorts are licking their chops. I would be. The first time it comes up here and then starts to roll, bam, right there. When it starts to roll over, that's your short. And your cover is right up a little above there. I go into some of this stuff in the short selling workshop that I taught. Okay, a few more. I'll bet you're amazed that I'm going this long, huh? Me too. But this is important stuff, okay? Maztec, again, we're just kind of looking at construction. Okay, watch the 50-day moving average. Watch how it behaves down here. This could be a, quote, double top. Okay, fine. But it could just wind up being one big, long consolidation. So if it comes back here, go ahead and take your shot. But your stop's right underneath here. Stop's right underneath, say, 30 bucks. If the stock starts trading below 30 bucks, then go ahead and get out. And by the way, I know what you're thinking. Yeah, but Dan, why would we want to get out there? Because actually, like, this would be a congestion area, so couldn't we just draw a line over here and say, well, I think we'll hold it to 29. Okay, well, that's fine. Meanwhile, you hold it to 29. Meanwhile, stock keeps trading away. The 200-day moving average comes up. You're holding it to 29. Well, it doesn't bounce. It keeps going. Well, now you're going to hold it till it tests the 200-day moving average. Meanwhile, the market's doing what it's doing. And then that happens. And now you're saying, like, you know, I should have just sold it at 29. Okay? So, or underneath the 50-day moving average, I should say. You should have sold it right there. So the point is, you have your plan, and then you execute your plan. Now, here's what I want you to do. I want you to go get a drink of water because I've been talking a long time. Then I want you to go back and review your notes before you join your family. Take some time, review your notes about the basics. Put those notes in front of you tomorrow. Stick them on your screen. Do something. Put a bunch of Post-its on there. But the number one thing, if you forget everything I said, here's what I want you to remember and do. Journal. Start writing down your trades, because what you're going to find is you are going to be your best teacher, not me. Because every single person has their own unique set of mistakes. You've got yours. Do you really care what mine are? Do you really care what the next guys are? What you care about is what your mistakes are. So you journal those, you write those down. And what you're going to find, again, I promise you this, you are going to find that you make fewer mistakes because you know what your mistakes are. And then here's the other thing, it's a little twist. The mistake that you make, craft a rule that's the antithesis of that. Okay, the antithesis of that. Don't say, oh, I don't want to do this. I don't want to do that. I don't want to chase stocks. You know, don't talk in the negative, because the brain doesn't understand the difference of not, don't, won't. All it understands is the basic gist without the don't and won't. So craft a rule about what you will do. I will buy at support. If you don't buy at support because you're always chasing stocks, then don't write as your rule, I won't chase stocks. Like, what the heck does that even mean? Okay, instead, your rule is, I will buy at support. And then before every single trade that you make, you look at your rules. Okay, are you buying at support? Okay, well, if the stock's running away from you, i.e. you would be chasing it, then you know you're not buying at support, don't you? Okay, so guess what? Don't do that. Wait. You are going to find, if you do this, this is going to be the most important video that I could possibly give you. I can talk about all these stupid stocks that you should buy or sell or this or that, but all that stuff changes with every tick on the chart. I'm talking about trader development. What I want you to do is look and see that the best possible stock that you can own is stock in yourself. And the way you can do that is by just continuing to learn and develop. You're not going to do that if you give up. And you're not going to do that if you don't journal. If you just continue to make the same mistake again and again, please let me know that, and I'll give you my mailing address. I would appreciate it if you would just send me your money as opposed to just give it to the market, because one way or another you're gonna lose your money if you're not writing down your trades. And I'll challenge you to do this. If you say, well, I don't need to do that, go another 6 months. Then look back over the last 6 months and ask yourself, would I have maybe done better if I'd have started writing down my trades and what my issues were? So do that, okay? I promise you, you're going to do a much better job at trading, and you're also going to be able to handle this mess, because here's the deal. Tomorrow, the market's going to open up, and the day after that is the weekend. Next week, it's going to be trading, etc., etc. You don't have to trade every day. What you want to be doing is making money, and the best way to make money is by losing less of it on days like today. Okay, that's it. I want you to have a good evening, whatever's left of it.